Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Prerana Seth, Fixed Income Strategist. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. In this third episode of our mid-year Outlook series, we today discuss our outlook on the fixed income markets. Global bond markets managed to score marginal positive returns in the first half of this year, despite facing bouts of volatility. The MOVE index, which measures the volatility in the treasury market, jumped in the first half of the year. Increased volatility in the short-term yields mainly contributed to the overall bond volatility due to uncertainty over monetary policy. We believe that we are now closer to the end of the central bank tightening cycle, and the Fed may be largely done with rate hikes. But monetary policy is still likely to remain tight, even if the Fed remains on pause mode. Growth prospects have been better than expected based on strong services activity and resilient labor market. Hence, we believe that risk of another rate hike cannot be completely ruled out. At the same time, continuing evidence of strong growth resilience, particularly out of US, should push back the possibility of a rate cut. The uncertainty about the timing of a rate cut could remain a source of volatility for the bond markets, and hence we remain underweight on fixed income overall. In our June tactical allocation changes, we had reduced our allocation on developed market sovereigns from overweight to underweight, and we maintained that underweight stance on developed market sovereigns. Along with the Fed, the ECB, and especially the Bank of England are likely to remain in tight mode in the next 3 months, which implies monetary policy uncertainty will remain. However, we still maintain our preference for the 7 to 10-year US Treasuries. Long-dated US Treasuries have underperformed recently, with incoming data pointing to US growth outperformance. But we believe there is limited upside for long-term US Treasury yields, taking into account the current end phase of the Fed tightening cycles. At the same time, we wait to add exposure to other long-duration fixed income assets once there is clarity whether the Fed has actually entered a pause mode. Our historical analysis of the previous 5 Fed tightening cycles shows that global corporate IG and US IG, which are predominantly long duration assets, were the best performers in the periods 1 month to 12 months post the last Fed rate hike. However, given the risk of another rate hike still tilted higher than the pause, we maintain our neutral stance on developed market IG corporate. We also recently trimmed our underweight on global high yield, as short duration assets could perform well in the near term. But we still maintain that underweight stance, taking into account the expensive high yield valuations during the current late phase of the central bank tightening cycles. In emerging markets, we increased our allocation to emerging market local currency. This was back in June, on the expectation of a faster monetary policy accommodation in the emerging market compared to developed market. And finally, on emerging market dollar sovereigns, we remain neutral and maintain our selective preference for high quality emerging markets. This includes GCC high quality and Oman. As always, thank you so much for listening to our podcast, and we hope you find it useful. If you do, please share it with your friends, family, and colleagues. For more information, please do reach out to your contact at ADCB. You can also log into our website www.adcbam.com. This is Prerana Seth signing off.